Good morning and Jai Hind. In this video, I am going to start the fourth chapter in your book, that is Process and Basis of Accounting. So let us study about process of accounting first. These are the various steps while uh, preparing the accounts or while doing accounting. So the first one is the identification of transactions. In business, there are various kinds of transactions. So, first we have to identify those transactions which should be evidenced with proper source document. Source documents like cash memo, purchase invoice, sales invoice, pay in slip, checkbook, passbook, etc. After identifying all the transactions, the next step is to preparation of vouchers. So, on the basis of the source document entries which we had done earlier, we have to record these on the vouchers. Okay, and from that, we have to record all these transactions in the journal entry, which is the third step, recording in books of original entry. Journals are the books of original entry. Okay, with the help of those vouchers, we used to record all the transactions in the journals. If our business is quite big, that means various kinds of lots of transactions are going on, then we have to record all these transactions in a separate head, or we may call that as subsidiary books. Okay, this is again a kind of journal only. So all the transactions are either recorded in a journals or in subsidiary books if a business is quite big. Then after recording the transactions in journals, the next step is to post it on the ledger. Okay, using those entries which we have posted in journals, ledger is prepared. And the last step, after preparing the journal, we have to prepare the trial balance and the financial statements. Okay, in financial statements there are profit and loss account, and using that we can make balance sheet also. Okay, these are the various steps which we follow while accounting. Next is our basis of accounting. See, to ascertain profit or loss, two bases are used. Okay, that is cash basis and accrual basis. These are the two bases to ascertain profit or loss. Okay, let us learn about them one by one. Cash basis of accounting. See, it is written here, income are not recorded unless they are received in cash, and expenses are recorded only when they are paid in cash. Okay, that means under this basis, uh, when we have earned some income, okay, if we are expects any kind of income or money in which is going to come to us, we have to record that transaction only at that time when we receive cash. If we don't receive cash, we don't use to record that transaction until we receive the cash. Okay, in monetary terms, the amount for which the transaction it is, the amount should be uh, come to us in a form of cash only. Then only we have to record. Okay, and similarly, if we have made any kind of expense, we have to record that expense only when we paid for that. We pay for that expense in cash form only. Then only we have to record that transaction. Otherwise, we don't record under this basis. Okay, let us see the advantages of cash basis accounting. The first is simple. This method is quite simple. Obviously, whenever the cash arrives to us or when we pay, then only we have to record this. Realistic. It seems quite realistic. Obviously, in before times, it happens. It is our mindset, in fact, that whenever we receive cash, then only we assume that we have earned something, or when we pay, then we assume that we have given something. Okay, something is gone from us. So it seems like it's very realistic. It satisfies conservative instincts also. Those, just like I just said that previously, many years back, people used to think in this way only. Whenever the cash arrives to them, then only they feel that they have earned something. Okay, whenever they feel cash in their hand, in fact. Okay, and when they give the cash from them, then only they feel that something has gone out from their business. This is a very conservative approach, so it satisfies those people also, and it doesn't require estimates and no room for personal judgment. Like, it can't be manipulated. Okay, there is no scope for manipulation on the side of accountant. So whenever the cash arrives, then only it can be written. We can't make any changes in between. And it is suitable for firms dealing in cash transactions only. Mostly those firms which are usually deals in cash, it is very convenient for them to use this method, isn't it? It is very convenient. So these are the advantages of cash basis account. Now there are some disadvantages also. Let us see. Enhance ambiguity due to. See, uh, and this because of using this method, that means cash basis accounting, it doesn't represent or doesn't show the clear and the true or fair picture of the profit or loss or the financial position of the firm. How happens? Because it ignores the outstanding expenses. Outstanding expenses are those expenses which we have to pay in past, but still we haven't paid. Okay. Next is, it ignores prepaid expenses. Prepaid expenses are those expenses which we have already paid in advance. Okay. It may be it may happen that we may pay for those expenses in future also, but still we have paid for those expenses before time. Those are the prepaid expenses, and cash basis accounting used to ignores these outstanding expenses and prepaid expenses. And similarly, it ignores the accrued income. Accrued income, that means uh, that is the income uh, which we are going to earn in coming future. Okay, or which is supposed to be earned. Okay, and it ignores the income in advance also. That means suppose somebody had ordered us something and given us some advance. Still we haven't given the services, but still we have received the advance in earlier. So in that case, these income is also ignored by this uh, cash basis accounting. That's why it doesn't represent, doesn't shows the exact and the clear or fair picture of the profit and loss. Okay. Next is, it doesn't match principle of accounting. That means, for example, let us see that when acquisition of goods will have to be treated as expense of the period in which payment is made, instead of periods in which its benefit is derived from them. See, whenever we used to uh, earn something, we have to match the our earning with the expenses for that period only. Suppose we are considering for the year 2020, 2019. So during that period, means on from 1st April 2019 to 31st March 2020. This is a 1 year accounting period, and whatever the expenses and whatever the income which we have generated in a whole year, these are should be matched uh, to conclude about the profit or loss which we have earned during that period. As we are only considering the during in this process, as we consider the income only when there is uh, when only when there is when the income is received in cash form. So it may happen when we are using, or when we are taking the benefits of the services, or we are if we are providing any services. It may happen that uh, the income which we generate from those services may come in the next financial year. So we can't match the income and the expenses of that particular period. This is the major disadvantage of the this current cash basis of accounting. Okay. Next is the possibility of profit manipulation. Obviously, uh, from accounting side, it may happen that if if we can't match the expenses and income in a particular period, it is very easy for accounting to manipulate the profits and losses, okay, in the eyes of management also. To in fact, it may accountant may enhance the profit to in increase the worth of the firm, of which may be not true, which may be it's manipulation only, but it may be created by the accountant also. So it is a this is again a major disadvantage of this accounting. And last is it is not recognized by the Companies Act 2013, because all these disadvantages which we have discussed, these are very major faults, and because of this, this method is not recognized, not approved by the Companies Act 2013. Okay, with this I am going to end my session, and in the next video we will learn about the second basis of accounting, that is accrual basis. Thank you.